Welcome to Scale and Sell, Module 1, De-risking your business. So here's what we're going to cover in this first lesson. We're going to take a look at the 8 things a buyer is really looking for when they're evaluating your business, how to make your bottom line look absolutely irresistible to an interested party or to an investor, and finally, 3, gotta have them systems if you're absolutely serious about selling your business. So let's dive right in. The 8 things a buyer is really looking for when they're evaluating your business. The first thing is your financials. They want to see the trend in your business is a positive trend. It's not erratic and it's definitely not negative. An interested party is going to want to see a minimum 3 years of your past financials. Now, obviously, they're going to want to see that your business is profitable. That goes without saying, but they're going to look a lot deeper than that as well. They're going to want to see that upward trend, that beautiful positive trend. They don't want to see an erratic trend or definitely not a negative trend to your business. A beautiful, smooth upwards trend over the previous 3 years, both in revenue and in profitability. So let's say we're looking at 3 years financials from, let's say, 2017, 2018, and 2019. Now, ideally, you do not want your business to have had a really great year in 17, then to have perhaps dropped away in 18, and only been able to match those 18 numbers in 2019, because the question will invariably be, so what happened in 2017? What led to that brilliant year? And why haven't you been able to repeat that in 18 and 2019? And most importantly, what's going to happen in 2020? Is it going to fall further away? So it's really important that you're doing everything you can to give your business that beautiful upwards trend. It's going to give an interested party confidence, of course, that they're looking at something with real potential. It also gives you confidence when you're creating your blueprint for the future of your business, and that's something we're going to get into a little bit later. It's not the end of the world if your business does have an erratic trend or even possibly a negative trend at some point in those last 3 years. It's not the end of the world, as long as you can easily and confidently explain that away. By way of example, imagine you run a wine tour company in California. And in 2017, you had a really great year, did around $350,000 in sales. 2018, a big part of it was a real disaster due to the Californian wildfires that they experienced in that year. And your revenue dropped considerably. It was a really terrible year for circumstances beyond your control, but in 2019, you were able to really bounce back hard. All of that hard work that you'd put into the business over the few years previously really paid off, and you had a great year in 19. You actually surpassed your revenue from 2017. So pretty clearly, you're going to be able to explain 2018 away very, very easily, and it shouldn't really have any impact on the way you value your business. You should be able to justifiably draw a line through your performance in 2018 and base your valuation off the results of 17 and 19. But we'll be diving deep on how to value your business later in the program. So the next thing that an interested party is going to be looking for are a set of clean, well-organized, uncomplicated books, uncomplicated financials. The key when you're looking to attract interest in your business is for your financials to be as easy to understand as possible. They've just got to make sense. If the way you manage your books, your financials, is complicated, difficult to follow, irregular, even though there may be nothing to hide, it'll likely end in an interested party walking away. It's hard to get investors interested in a business with confusing books. So keep it easy, keep it simple. Number 3, are there any dependencies? Is there a major dependency on the owner? I.e., does the owner have all the systems in their head? Does the owner run all the trainings for staff members or contractors? Is the owner delivering the service or the majority of the service? Does the owner manage all the relationships? If there's no owner, is there a business? Because for the most part, if the owner is the business, then if you're inevitably going to get the question from an interested party, a potential buyer, well, what exactly am I buying? Next, does your business have a dependency on a particular one or a few clients? If 70% of your business comes from one customer, then it's unlikely anybody is going to touch that business or invest in that business. If this is your business, then it needs to be a priority for you to start opening up new sales channels, new revenue streams, new markets, new types of customers. Your aim is to be looking at a beautiful pie chart with a number of healthy looking pieces of pie and to move away from having an over-reliance on one customer or one type of customer. To illustrate, this is the pie chart for my business in 2017, just a couple of months before I sold my business. As you can see, 5 fairly healthy looking pieces of pie. To be honest, my goal for 2018, if I had remained in control of my business, was to address what I felt was a small over-reliance on the amount of business that I generated via a handful of travel partners, and to reduce that piece of the pie to grow other pieces of the pie. But for all intents and purposes, I felt fairly secure, fairly comfortable, at ease, knowing that I had a really good spread of revenue. And if, let's say, I hit a lean time with a number of travel partners that focused on a particular international market, then I could double down on my direct sales and really put some focus there. Or I could double down on the corporate market and try to grow that area of the business. It gave me a lot of scope to shift focus and drive bookings from other places. Similarly, if your business has 1 or 2 major suppliers or sources of bookings or reservations or sales, so if your inbound tourists are all from China, or 90% of them are from China, or let's say you run a maintenance business and 90% of your revenue comes via one client in one high-rise office building, or what if you're a corporate travel agent with a global contract at PricewaterhouseCoopers or Amazon that accounts for 85% of your resources and revenue, then priority number 1 for you is diversification out of major client dependencies. Number 4, an interested party wants to see that suppliers, staff, and customers are all locked away with some form of agreements, some form of incentive to remain loyal, or ideally, a contract of some form or shape. So how does this look? Well, for your staff, it would be something like a signed letter of offer and a position description that they've signed off on. It would also mean something along the lines of a performance incentive or a bonus scheme. Here's an example of one that I used in my business. Now, every member of my team had one of these. We called it our personal development plan, but effectively it was an incentive scheme. So here's an example of what it looked like. There were 2 major areas. There were company-wide objectives, which generally totaled 5 or 6 per employee. And as you can see, it included things like adherence to your vision, mission, core values, and brand promises, and demonstrating how they were sort of living and breathing these things. It included communication, completion of agreed tasks from their position description, and a requirement for them to demonstrate how they were continually improving. So providing examples of improvements that they had implemented and how they had benefited the company. And lastly, financial targets. So we always had a stretch goal, a company stretch goal, and we had a minimum acceptable. So the beauty of this was, first of all, every employee was given an opportunity to rate themselves, and then management also gave a rating for each of these. And then the next part was role-specific objectives. So this particular personal development plan was for our operations manager. So you could see there a really key area of that was their general operations, things like recruiting, training, sourcing of vehicles, managing inventory. Now there would have been 5 or maybe 6 role-specific objectives. I've just used a couple of examples here. So one of the most effective things about this personal development plan, or you might call it a bonus or incentive scheme, was that the onus was put on the employee to rate themselves, to really consider the various objectives and to score themselves and to provide examples and demonstrate why they'd arrived at that score. It was a really powerful part of the process. When they sat down with management for their mid-year review or end-of-year review, they were asked to provide examples and to demonstrate or justify the rating they'd given themselves. So even though management had already rated them in preparation for the review, it gave an opportunity for the employee to change management's mind about the score that they'd given them. If they could successfully demonstrate why they had achieved the rating that they'd given themselves. So we caught up 4 times a year. There were 2 progress meetings. There was a more formal mid-year review, and then there was a final annual review in the last quarter of the year. And there was a really clear scoring system, so an employee knew how they were to score themselves and the benchmarks that they were given. And then the key to this was that they had an opportunity to earn 10% of their salary in bonus, and the bonus value and the timing of the bonus was determined by management. So in effect, an employee was effectively tied into the business, because when they sat down for the scheduled review, and by the time their ratings were formalized and the manager or the director had signed off on the bonus and the bonus had been paid, they were effectively, sometimes 2 or 3 months into the next quarter. And if a staff member resigned, as per their employment contract, they weren't eligible for any bonus payment in the quarter that they resigned in. So it gave that extra little bit of incentive for an employee to remain loyal to you. So next, your suppliers. It's really, really critical that you get pricing and inclusion details, plus other important terms and conditions about the service that they provide you or the product they provide you from all of your suppliers in writing. Having these kind of things documented is going to give an interested party a lot more comfort about moving forward. So whether it's formal by way of a contract, whether it's informal, anything in writing is going to be immensely valuable. So things like, as I mentioned, your agreed price and inclusions for the product or service, the date of the next review for that product or service if you have one, or it might be a suggested date of review, any blockout dates, any dates throughout the year that they're unable to provide that product or service to you, and any other important terms and conditions that you can think of. So basically, something is better than nothing, and an interested party doesn't want to know about verbal agreements with suppliers. So moving along, your customers. Now clearly it is not always possible for you to get a formal agreement with a customer that they're going to continue to use your service. So what can you do? Well, I'll give you a few examples from my business, which was in the travel industry. So one of my biggest clients, a company that generated around $200,000 a year in sales for me, was a large American travel wholesaler. Now, I knew that this particular company, once a year, the owner of this company put on a big awards night, and effectively they invited all of their retail travel agents from all over the United States, all expenses paid, to come to a certain location. In the earlier years it used to be at the owner's house, but as the business grew they needed to find different venues, and they used to have this awards event in different locations around the United States. But anyway, we were often invited. This was at a point where I think at the time we were doing around $100,000 in sales with this particular company. So I said, could we sponsor a component of that event? Now, that was met with great enthusiasm. So for the next 5 years, we became the official sponsor of the DJ that they engaged for the gala dinner, the main event for these awards. So every year we made a $1,000 sponsorship payment to this company that helped them cover the cost for their annual awards night. Did it mean they were obligated to use us? No. But when interested parties were looking at our business and they said, okay, so this is obviously a really important client to you, they're doing $100,000 a year in annual revenue, is there any level of certainty around them continuing to use you in the future? And even just the fact that I could say that the relationship was so strong that we were an annual sponsor of their biggest event of the year, which was backed up by email communication, some really friendly back and forth emails from the owner, the president of this company. It was something, and it was better than nothing, and it gave an interested party peace of mind that that piece of business was going to stick around if they became the new owners of my business. Okay, so there was another client of ours that were also doing 6 figures in sales. They were a really, really strong client, probably about our 4th or 5th biggest travel partner. So in around 2015, I was in their office. I was doing a product update to their reservations team that were selling our travel experiences to their clients. And I was obviously very, very keen with any of our really valued clients that were generating 6 figures in sales for us to lock them in any way I could. So I said to them, have you ever considered creating call it a preferred supplier program? So getting a bunch of your best suppliers, creating this program that was really hard to get into, Then to get into the program, you needed to agree to provide them an additional 3% commission on top of the commission that you were already paying them. Now, some would have balked at that, an extra 3% on top of a 25% commission. But for me, that was money well spent. It wasn't money out of my pocket. I paid them when they generated sales. I had that margin built into my rates. And it was absolutely money well spent because it locked me into them. So it wasn't as hard hitting as a formal contract. I mean, they weren't obligated to use me, but I was in the program. They had promoted my company, my business, as one of their preferred suppliers, which means they had faith in me, which means they would have looked silly if they'd either bumped me from the program or had to go back to one of their clients, another retail travel agent in the United States, to explain that they weren't using me anymore, even though I was in their program. So it was just another way that I could ease the mind of a prospective buyer, an interested party, if they started asking questions about how solid the relationship with that customer was. Lastly, with our biggest customer. Now, this customer was generating around $240,000 a year in revenue for us. Hands down, they were our best customer. So what I did in 2016, I got on the front foot and I actually approached them with a proposal for an incentive arrangement. So as you can see from this email here, I approached them and I proposed that for the period July 1, 2016 to June 30, 2017, that I would pay them a 6% return in addition to the commission I was paying them, an additional 6% for all revenue over and above $187,000. So that absolutely locked our best customer into us. In the previous financial year, they'd done around $205,000 in sales with us. But in that year that they accepted my proposal for that incentive arrangement, they generated $230,000 in revenue, which was $25,000 in revenue more than the previous year, which meant that I paid them a 6%, an additional 6% commission on every dollar over the $187,000 that we'd agreed. But the thing is, it wasn't that much about that 6%. It was about locking them in, tying a customer to you that was generating $250,000 a year in revenue. And that is absolutely what an interested party wanted to see. And most likely it was the thing that got them really excited about the business. Because before it actually got on the front foot and proposed this incentive arrangement, if an interested party had said, so tell me about this relationship, how strong is it? Are they going to walk away if you sell your business? I would have had no answer for them. I would have had nothing but my word. So think about these things well before you make the decision to get your business to market, because these are not the kind of things you can scramble to get in place. If you have them in place well before anybody asks, it's going to be highly impressive. So start working on these written agreements, start working on these incentive arrangements, start working on these bonus schemes, start working on ways to lock your customers, your suppliers, and your staff into you right now. Okay, so number 5, an interested party is looking for a long lease. So if the location from which you operate is important to the business, then a prospective buyer wants to see that that lease is a really, really long one. So now's the time to get in touch with that landlord and see what you can do about extending that lease as long as you possibly can. Next, a buyer wants to see your personal expenses stripped out of your business. They want to see clean numbers requiring fewer what you could call add backs. So on this note, you want to make sure that an interested party's first look at your numbers is a look at your normalized numbers. So that means before presenting your numbers to them, it means removing any personal expenses or expenses that a new owner would not inherit. You want them to see the real numbers, the numbers that present your business in the best possible light. Next, a prospective buyer wants to see a blueprint for taking this business to the next level, i.e., what would you do if you had the resources and the interest in staying to take this business to a whole new level? Would you develop new products? Would you develop a range of upsells or experience enhancers? Would you enter a new market? Would you make significant changes to your product or service to appeal to new markets? A buyer wants to inherit a business that's going places. And lastly, they want to see right across the business that you've got systems and processes that are documented. So do you have standard operating procedures? Do you have your training processes documented? Do you have a risk management procedure? All of these things are absolutely critical. They want to know that you have documented literally every process or procedure that goes on in that business. So if they have a question, then the question's already been anticipated and a process has been built out and documented. If procedures, systems, processes are in the heads of the owner or the heads of key staff, then they'll likely walk away. Basically, it boils down to this. A buyer, an interested party, is most often looking for reasons not to buy the business. They're looking for as few risks as possible. So your job is to remove every one of these risks you possibly can.